welcome out to the halftime report presented by Tackle Trading. Coach Matt, I got special guest Coach Noah from Tackle with us as well, and welcome out to all of the halftime crew out to the report. Good to see you guys as well.
And if you guys didn't notice, there wasn't a delay on the launch today because I'm back.
No, there wasn't a delay on the launch, but I do have a circle of death going on the report on YouTube side. Don't know what's going on. Noah, how you doing today?
That's not true.
I'm pretty good. Can't complain. Got a little cold, so I sound sexier than I normally am.
You do sound sexier than
I know, right? Like it's all very white up in here. Wow.
It's that late night DJ AM voice.
Oh,
yeah. Hey, no, go ahead and share.
DJ Streppy Strep Throat. All right.
Well, we're going to try to run that. We're going to try to run that voice in here today, Noah. So go ahead and share your screen. Let's take a look at the markets. Let's break down these markets one at a time. And for those of you who are new to the halftime report, we basically do. Again, Coach.
We should be live again right now.
Awesome. Coach Noah, we're back here on YouTube, and we will figure out technology at some point in our lives. I promise you that. Noah, we're taking a look at the S&P 500 here. What's your technical read on the marketplace, and are you considering this a breakout of the 200 SMA?
Well, I think that all depends on where it closes, Matt. We've got a pretty good amount of energy heading into this. Yesterday's candlestick up, I think with a little help from some of the Fed's commentary, really powered right up and closed right at the 200-period moving average, and then it immediately drifted up overnight, and we've been seeing it, closing above that 200-period moving average. One of the reasons we always want to watch for that close on a breakout is just that tells you what the professional traders are thinking. It's not being driven up by amateurs. Mm-hmm. It's really being, held through by the people trading at the end of the day who aren't the people who have day jobs. They're the professionals. So if the professionals manage to stay into the close, I think that's a strong signal. We are at the top of the range. We do have some slowing momentum, but what would you expect heading into a big 200-period moving average? People to become tentative.
Can you speak about why that 200-day moving average is important?
Because people were told to pay attention to it at one point in time. Sure. It's true, but the 200-period moving average originates from an annual moving average. They just rounded off the number of days they calculated to make the math easy. Mm-hmm. And it's 200 days is 252 days in a trading year. 200 days is the average, and it's just a big benchmark. It's taking 200 days of data and crunching it all out and just showing what the average price is over the last 200 days. And anytime you're below that, it's an indication of weakness. Mm-hmm. And anytime you're above that, it's an indication of strength. So it becomes a huge demarcation line. And people look at it like you'll hear commentators on CNBC talking about it and the other audio or the other, general media outlets that they'll mention it and they'll say, hey, this stock's trading at its 200 above or below. And when the whole market's testing that zone, it's worth paying attention to.
Absolutely. Now, in terms of the market right now, we did had a couple economic reports come out today. Number one was the CPI report, Noah. The CPI report is the consumer price index. It's a composite level of inflation. It's one of the most important economic reports that the Fed looks at in terms of justifying or dictating their monetary policy. And with the Fed coming into a dovish stance, the CPI report came in at 0. The core came in at 0.1 year over year at 1.6% inflation. Now, I'm not going to get into the debate whether that is a true level of what actually is in the future, because it allows them to print more money because inflation isn't too big a concern. It's the same thing that we saw in England over the course of the last couple of days as well. The other economic report, and I want to look at it very quickly here, is the New Zealand dollar versus the United States dollar, NZD/USD. New Zealand last night reported monetary policy, and they kept their rate at 1.75%, signifying the exact same thing that the central banks talked about last 2 weeks ago. European, the Japanese, the English, the Canada, all of these central banks all kind of followed the lead of the United States central bank, and New Zealand certainly did that as well. New Zealand dollar kind of coming up off that news. The dollar also is coming up off that news, and I'll talk about that here in just 1 second. Just wanted to point that out to the currency traders out there that This is something that will continue to happen in 2019 as you see that slowing growth argument really play out in 2019, removing the government shutdown, remove Brexit, remove the Chinese-U.S. trade deals. If you just look at that slowing growth situation, watch how these central banks all start getting more dovish and more dovish and more dovish. And, you know, there was a big concern coming into the year about China and specifically the Eurozone. But the Eurozone is kind of leading that slowing growth. I'm very concerned about the Eurozone, and that's going to be just something we will, you know, update people on as it plays out in 2019. Let's go ahead and look at the Dow Jones very quickly, Noah.
You bet.
Now
Noah, that strong close up above the 200 period moving average. You know, that's even retested, obviously.
What do you think is going on with the industrials right now? I mean, whereas the S&P 500 is just breaking out of the 200-day moving average, the Dow Jones broke out last week and then retraced back into that, held the ground at the 200-day moving average, and confirmed. Does this mean the Dow Jones is going to start moving up a little bit more aggressively than the S&P?
I think that's a pretty clear sign. It wouldn't be. It's had the best recovery of the bunch, I think. You know, the Dow, you're only lifting 30 stocks compared to the S&P's trying to drag up 500 stocks. But these are your big conglomerates and your big industrials. And I'm pretty bullish on the industrial sector in general. And so a lot of these big fish are actually, you know, doing pretty well, had strong earnings, et cetera, et cetera. So yeah, I'm taking that as strength.
Let's talk about this for a second, because I think it's important. When you see one of the index start to do a little bit better than the other indexes, how would you go about potentially finding trades within that index that are setting up that, you know, how would you go about finding a trade in that index?
Well, I just look through the Dow 30. Like in this case, looking through the Dow 30, you don't really even have to filter it. You just look at all the 30 stocks, find a good setup, you know, find the ones you like the best. You turn the Dow 30 into the MAP top 5 type thing.
Mm-hmm.
You know, but when it comes to like the S&P 500, I usually have to filter those up using a filtering mechanism. Yeah,
something like FinViz or TOS or something along those lines. Let's go ahead and look at the NASDAQ very quickly.
You bet. It wants to break that 200 period moving average. It thinks it can break that 200 period moving average. We'll see.
We'll see. Still underneath. But here's the reality, though, Noah. If the S&P breaks out of that 200 and the Dow's already broken out of that 200 and you see momentum coming into those indexes, even if it's lagging, the NASDAQ's going to break out as well.
Yep.
I mean, the NASDAQ's not going to decouple from the S&P, for example.
No, probably not. And I see a nice looking cup and handle here. If you look at it, it's just right there, kind of poised to break out. So I think we got a good setup for it.
Let me ask you a question. We're slightly bullish in the market right now, right? We're all slightly bullish in the market, kind of holding back, you know, some technical components, but really more that slowing growth and, you know, just geopolitical situations kind of is holding us back from being a little bit more bullish. But if you see the NASDAQ get above the 200-day moving average and the S&P get above the 200-day moving average and the Dow is already confirmed above the 200-day moving average, would you adjust your bias at that point to be a little bit more bullish?
I'd roll up my sleeves like Jim Cramer and start hitting the buy button.
Buy.
But yeah, no, I mean, it's definitely one of those things you have to consider the overall context. It's showing strength. You have more of a V-shaped recovery. You know, unemployment's low, inflation's low. All of the worry about slowing growth we'll have to see whether or not that's true. Mm-hmm. We've seen some slowdown. We've seen pockets of slowdown. But if the Feds remain dovish and the monetary banks, you know, around the world remain dovish, I think that's going to keep pushing that inflation envelope and trying to keep those assets and equity prices higher.
Mm-hmm.
So I think that's their intention, is to just keep things moving, and without, you know, tightening up the money supply, it'll help that.
Here's my one concern about it.
You just have one concern?
Well, no, I have lots of concerns. But here's one of my concerns about that is the fact that as this market does appreciate, this market is going up on the backbone, not on economics, but based on central bank, right?
Yeah.
Okay. So as this market continues to go up, doesn't the Fed have to come off their dovish stance just a little bit if the economy continues to improve in the U.S. and jobs continue to see 200 plus, growth on a monthly basis, and manufacturing data continues to be above recessionary levels, and housing data continues to be above recessionary levels? Doesn't the Fed lose an argument that they need to continue to remain dovish?
Well, yes, but I think they're addicted to the easy money crack.
Yeah, that's true.
I don't think it's a question of what they know they need to do. It's nobody wants to do it.
Here's what I just pray we don't get. The bad news is good news marketplace, right? The bad news is good news that we saw in 2015 and 2016 when Janet Yellen, first initiated the thought, not the action, but the thought that they were going to do something with interest rates, right?
Isn't that like buy the rumor, sell the news?
Yeah, pretty much, right? But again, I said this the other day, you don't build a sustained bullish marketplace on the backbone of bad news equals Fed dovish policy, right?
Yeah.
You don't build that sustained market in place. And so that's just my overall concern. But from an economic perspective, a fundamental perspective, you got to follow the price action. Those things keep us cautious, right? And those things keep us prepared so that we're ready to take action. But until we see some type of downward movement, this market wants to buy.
Yeah. And it comes back to that old saying, don't fight the Fed. We know that their actions create bubbles, and we know that at some point that bubble pops. But in the meantime, you don't fight the Fed, and you can't really predict what catalyst is going to be, the pin that pops the bubble. We don't know. So in the meantime, trade what you see, because I've been having these bearish sentiments since like 2014. And
well, to be fair, all of us at least since 2015, right? I mean, almost every trader since 2015 has been like, yeah, this doesn't make a whole lot of sense, right? This doesn't match our historical cycles, and it was something new, right? And then when we saw slowing growth in 15, Noah, I think all of us were ready. And when I mean slowing growth, I meant slowing, momentum in the marketplace.
Right.
I mean, in 2013, you went from 32% growth in the S&P to 2014, you went to 14% growth. And then 2015, you went to it wasn't a negative, it was like 1.5%, right? So you had this slowing growth environment, this slowing momentum. And so from a technical perspective, we were getting ready for reversal patterns. But then Janet Yellen basically said, nope, our target on the S&P is 3,000, basically, right? And it just thrown all that out the window. So you got to always, even though economically you got to be prepared for those types of situations to come at us, technically you got to trade what you see. And if this market does, if the NASDAQ breaks out of the 200-day moving average and the S&P breaks out of the 200-day moving average, and you have the Dow already on top and confirming off a retracement on the 200-day moving average, that has to be a catalyst for price growth. Would you agree?
Yeah, I would agree. It's a very strong sign. So go with the flow, trade with the trend. The trend is your friend.
Where would your target be if you're looking at the S&P, if you're looking at the Dow, if you're looking at the NASDAQ? Let's look at these resistance levels in the marketplace. So in the S&P, where would that next step on the target be?
Well, I mean, at this point in time, you're clearing 2,700. You got some support resistance at 2,800, and then you're just going in $100 increments. I think at that point in time, 2,900, $50 increments too. 3,000 is not that unrealistic. I could see it up in that ballpark by the end of the first quarter, or not the first quarter, excuse me, second quarter, maybe third quarter. Because it's, the amount of time it's taken to get to where it's at right now from those lows. So I would say, we have known benchmark price points. We just keep an eye on those. And then the real question is will it clear that high? I think it'll come back up and try and retest here. And again, that could all change, very quickly if the right catalyst came along. But in the meantime, again, don't fight the Fed.
Well, it's not just the Fed, though. I mean, look at some of those hurdles that we've been concerned about, right? I was never concerned about the second government shutdown, but you removed that obstacle from the market, and the market, even though I thought, I was telling this to Cody, Cody's like, yeah, the market really responded to the good news on the government shutdown, signals that Trump's going to sign that deal. And I'm like, yeah, but that's kind of
good news. Yeah.
That's kind of a silly reason for the market to buy on that, right? I mean,
Well,
it really is. It's a big catalyst.
It kind of reminds me of some of my friends from college. You don't need a real good reason to party. You just need any reason to party.
You just need any.
It's Wednesday night, guys. Like, what are we?
It's Wednesday.
What are we doing? What are we doing here?
We made it halfway through the week.
Yep. So,
hump day, bye.
Yep.
Hump day, bye. It's just the reason, and I get that. But sometimes you look at those headlines, you're like, oh no, okay, whatever. But it does remove one of those catalysts, right? And then just today, Mnuchin signals that talks are going to be going good, right? Trump today signals that, if we don't get a deal by that March 2nd deadline, well, we're willing to come off that if we have progress coming into it. And so with the Chinese-U.S. trade war over the course of the last year, you have positive headwinds, and obviously a deal isn't done, but the right things are being said in that capacity. So that Chinese trade deal is, and again, this could flip on a dime. We all know that. But each day it seems like they are progressing in those trade talks. I mean, the market's seeing it, we're seeing it, our whole community's seeing it. You're removing one of those obstacles. Another obstacle is Brexit. And Brexit basically is this: either you take the Brexit deal or you have a hard out, right? That's where we're at. And the most likely scenario in that, guys, is the exact same thing Trump said regarding the Chinese trade war. If they don't get a deal done by the March 30th deadline, well, Theresa May is already asking for extensions there. So I'm not saying that Brexit is being removed, but you're seeing delays there. And I don't think you're going to get a hard Brexit. So I do think they're going to negotiate and give a little bit more time on that Brexit deal. It just seems like, these things that we have created, and I mean that, these things that we as an economy have created, that the Chinese trade war, the Brexit situation, the government shutdown, that's all humans doing, causing these issues. Slowing growth is a real concern, but that's not going to play out in a day. These things are playing out every single day, and every day you have more positive momentum coming back into the market because these obstacles are being pushed aside to a certain extent, and understandably so. So in terms of this, how should a trader go about their routines? Should they change anything as these things change, as these things go further into the mind? My point is, at what point do you get aggressive?
Get aggressive with the bullishness?
Yeah.
What's to say I'm not already being aggressive?
Well, I know, but we are slightly bullish. Right?
Yeah, no, I've been very, I'm always cautiously bullish. I personally don't like to get overly aggressive.
Mm-hmm.
Wait, as a trader, you don't go all in on one direction?
Well,
No.
I have.
That just sounds like you know what you're doing. Like,
I have in the past, Cody, and I learned real quick how to lose money. When you go all in,
can't teach you that.
Yeah, the market can take you out behind the woodshed and give you a severe beating, and you'll learn something from that. You won't have any money left over, but you'll learn something from it. So I'm always cautious on that, and position sizing and stop losses, and I try to keep my portfolio balanced as best as I can. Just because I know that the market is fickle, and even though all signs point to yes, as the magic 8-ball says, I still have risk management in place and position sizing. When I get more conservative and nervous, I pull back on position size, but I'll still trade this. I'll still trade the trend. And so probably what I do if I'm getting more aggressive is I just end up with more positions.
Yeah. And one way that we kind of determine how aggressive versus defensive or conservative or bullish versus bearish, however you want to categorize it. But one of the ways we kind of do that is a concept called delta weighting. Right? Correct? Delta weighting is basically how you match your delta versus your portfolio. Can you talk about delta weighting for a second?
Yeah, you bet. Again, delta is your sensitivity to your direction. It's directly correlated to your position size in stocks. Like if you have 100 shares of stock, that would be a 100 delta. If you owned it positive, you'd be bullish. If you'd sold it short, you'd be bearish. Your options positions, when you buy and sell options, each has a positive or a negative delta according to whether you buy or sell it. And you basically build your portfolio using the strategies that match your bias. You build your delta to match your bias. And then, there's trading strategies that involve delta neutral. When the market gets bearish, you want your delta to match the trend. So I usually have my delta matching the trend. And as I become more bullish, my delta increases. And as I want to lock in gains, I start to decrease that and turn it into a more neutralized portfolio. I do a lot of adjustments, Matt. So when I start out with even a strong directional trade, it's not long before I've shifted that and changed the trade to something more delta neutral. Start trying to take advantage of one constant in the market is time decay. So you want to basically know how and when to open up your portfolio delta, because that's when you get really good capital gains. Otherwise, I think your goal is to focus on cash flow. And I think that's a big challenge for traders, is knowing when to open up the delta, when to go for the gold on that. And, it's kind of a Pareto distribution. You'll end up with 20% of your trades will end up giving you 80% of your gains. And it's just knowing when to again, step on the gas.
Well, and that's kind of what this whole conversation is about, is when to step on that gas, when to adjust that delta into more of a positive delta so that you're more directional, right? And whenever you go more directional, you're going to give up some of your positive theta because you're buying options or, something along those lines. So, a slightly, in my opinion, a slightly bullish delta coupled with a slightly positive theta is the best way to go about this market right now.
I mean, let me give you an example. I think I can just show you an example here of what that would look like. This is actually a pretty bullish delta right now. It's quite bullish on that delta column.
Yeah, can we delta weight that real quick, Noah? Beta weight it.
Beta weight it. So if I beta weight it against the SPY, for example.
SPY.
Okay. It's bullish, but it's a little over manageable. I usually personally weight it against the futures. And so I'd need 2 contracts on the futures to hedge that. That means I probably want to pull it back because I don't like to hedge with 2 contracts if I can do it with 1. So I need to look to that. And I've got a theta problem, Matt. I've got almost all my theta positions. I'm not in an account. I'm not in the right account. This is my other account. So it just took me a minute to figure out, hey, why is my theta so low? It's like, oh, this is my other account. This is just my delta account for master trader classes. But
gotcha.
So that makes me want to log out. But that's the idea is you want to manage that, that position, and you need to know your risk. If the market were to shift suddenly, this really gives you an idea of how much insurance you need to get.
Hey, switch back to the SPY here, because I use the ES as well, but for most people, they use the SPY.
You bet.
So switch back to the SPY, and I'll kind of talk about that delta, what that delta represents. Okay, so that delta, it's 712, right?
It's 712, which would take it's going to take a ton of cash to hedge that.
Oh, it'd take a ton of cash to hedge that. But what does that 712 represent? Because a 712 delta represents different for a $10,000 account than it does, say, a $100,000 account versus, say, $1 million account. Because if you have $1 million portfolio, that's not a bullish delta. If you have a $10,000 account, that delta is a ridiculously bullish delta.
Yeah. So if you go with the start out with what the beta is just a fancy word for how much stock A moves compared to the index. If you got stock A and stock B or stock C, how much do they move? If the S&P moves $1 and stock A moves $2, that one needs more insurance. If stock B moves, 50 cents, that one needs less insurance. And so it's measuring your stocks against the S&P. And ultimately what that number means is if the S&P rises 1 point, on average, your portfolio is going to make $712. If it falls 1 point, you're going to lose $712. And so if you could imagine if the market took a 50-point drop suddenly and you were leveraged at 712 or so, that's going to hurt. That's going to cost you some money. And it's really just your sensitivity. It's your sensitivity to the market movements and, bullishness here. And it's definitely a bullish portfolio. And to ensure that, you'd have to go buy put options. And that would take, I don't know, 15 or so put options with a delta of 50 or so. You
would have to have 15 at the money put options to hedge a 700 delta.
Yeah. Yep, thereabouts. So
and that's not a small position.
No, and if you want to go look at that, and you kind of go look at the SPY, and you look at, if you wanted to buy that insurance, say through May,
mm-hmm.
and you added up the cost of that. So let's go out to, buying some May insurance policies here, and you're going right at the money. You're talking about,
and that's if you want to hedge 100%, right?
Yeah, $786 or so, $787 times 15. So that adds up quick. You'd have to have the capital and cash. Yeah,
it's about $12,000 position. But again, the whole concept of delta weighting is basically you want to match your delta with your market bias, right? You always want to move in the direction of what you believe the market is. And so if you are slightly bullish in the marketplace, you want to carry a slightly bullish delta. Now, obviously, you need a little bit of understanding about how to weight your delta against your portfolio and understand that, for example, I know for 100%, if you have a $100,000 account and you're carrying a 700 delta, that is a bullish positive 2 delta. That's what that represents. If you have a $200,000 account, that would be honestly, that'd be close to a slightly bullish or neutral delta based on that account size. So obviously we might want to do some breakdowns further on, but I just want to talk about that delta weighting for a second, because that is such a good tool to ensure that your portfolio truly is built in the direction that you think the market is going. And so what we do as traders, guys, is as the market does break out, we're looking at that delta and we're saying, okay, I need to add more positive delta to my portfolio as the market is gaining steam. And if the market starts slowing down, I need to start locking in a little bit of that positive delta, so that I can, reduce my delta. It's not even really about locking in gains, although that's exactly what happens. It's more about just reducing your exposure to the overall marketplace. And there are times when the market's very bullish, but I'm carrying a neutral delta. For example, if the market's overextended, and a lot of our stocks that we're trading are overextended, in a bullish environment, you could literally very easily still carry a neutral to a slightly bearish delta, because you're locking in your gains on your positive delta transactions, waiting for them to come back down so that you can reset and hit them again, right? You always match your delta with where you think that market is going. And maybe we'll do a deep dive on delta weighting in one of these coaches shows coming up. I think that'd be a very, very good, in fact, halftime crew, if we did a deep dive on delta weighting portfolios in either the coaches shows, it would probably be the coaches show. Would you guys like that if we did a deep dive in the coaches show coming up?
I'm interested.
Yeah, let's definitely do that. No, let's move on and look at some of the other components in the market outside of the actual stock market. And let's first start with the United States dollar. What's your read on the dollar, Noah? A lot of momentum coming into that puppy.
You know what? I think it's going to break out. I've been pretty neutral on the dollar, but I think it's going to break out, especially if you see a Chinese trade deal go through.
Agreed.
Yep.
Well, think about it. Let's map this out. Every central bank is going dovish, correct?
Seems to be.
Okay. So it's a race to the bottom. But in currencies just don't go down. Right? They're traded against one another. So some currencies go down, other currencies have to go up in price. The dollar is the best of that bunch by far.
Yeah, right? I would not bet against America.
Nope. So in terms of the slowing growth environment, every central bank is going dovish. The slowing growth is really a global growth and not necessarily a US based concern. Right?
Well, I mean, it's always a U.S.-based concern, but yeah, it will
we'll
be okay. We'll be okay.
Yeah. We're not going down like Europe, right? So, okay. So in terms of that, you have a slowing growth global environment that doesn't necessarily reflect the economic value of the United States. And even if we slow down a little bit in comparison, simply because the world is slowing down, right? Not necessarily what we do, but because the world is slowing down, you could certainly see those other currencies going down, with the dollar appreciating on the back of the strength of the U.S. economy in comparison to the other economies.
Agreed.
So if that dollar breaks out, how's that going to impact gold, silver, oil?
It in theory should make them go down, but I think they're not going to be negatively correlated. I think gold's going to stay strong. Oil's the one I question the most. I don't question so much precious metals at this point in time because they have a very finite supply. And I think that I'm not quite sure what the psychology and reasoning is behind it, but you're seeing a big, land grab, so to speak, for gold and silver.
Especially at central banks and governments.
Yeah. But with oil, there's that big question of inventory. And you've got all these oil producing countries just pumping and pumping and pumping. And I think that's going to keep the price artificially low.
Let's go ahead and look at oil very quickly. What's your read on technically?
Well, let's take a look here. Good old crude light. It's got the makings of a reversal setup. It's got the higher low. It's got some upward movement. There's an inverted head and shoulders pattern in there. So it's got the makings of a breakout. It's just a question of if it's going to manage to break probably above that $55 mark.
Mm-hmm.
And even if we see it appreciate, I don't know if we see it go much past $60 to $65.
Yeah, you break out of what's that ultimate high? About 55.75?
About 55, 60, 70, somewhere in that ballpark.
Okay. That's where it has to break. But if you break that and you do run to 60, which would be my price target as well, I mean, that's still still a 7-8% return on oil.
It's a decent move.
That's a big move in oil.
I'm not opposed to trading it, but I wouldn't load up directionally. I'd take the money and run,
No, it tried to fool us that once above 55. I'm a little more cautious on it this time. There's no doubt.
Yep.
All right, let's take a look at gold.
Now, I like this setup for gold. It's a decent pullback into rising moving averages, a support zone, and it's testing that $1,300 ballpark. And I think we'll be testing the 1360, 1370 highs.
Nobody ever knows what the future holds, but try to find me a better looking chart than gold right now.
It's a pretty good looking chart. And it's got, if you look close, Matt, it's got that little double bottom on that pullback. It's got those two candle lows, and then it's starting to rise up again, and it's just trying to break out. So if you were to change that to a smaller time frame, you'd see like a W pattern and a potential breakout setting up.
Mm-hmm.
So that's a good looking chart setup. And the demand has been strong. And again, you got fixed supply. And so unless sentiment changes on that, which again, I think there's enough concern over slowing growth globally still that you've got people hoarding the gold, buying it up.
Well,
not just people, like governments and things yeah.
And I get the dollar should rise on the slowing growth. I do understand. But with every central bank going dovish, you just got to love gold even more. I mean, you just have to. Even if technically you don't love it, although I do, fundamentally and economically, gold should appreciate in a dovish environment. It absolutely should.
Oh, yeah.
Question for you. Silver or gold? If you had to pick one, and you can't do the Mike Maloney diversified, I like both. You got to pick one, silver or gold.
What's my purpose with it? Are we talking physical or just the charts?
No, physical is silver, but charts.
Yeah. Charts?
I'm talking not a swing trade.
Gold's got more strength right now. Yeah,
gold's
got more strength, so I'm going gold.
Me too. All right, let's go ahead and look at natural gas very quickly. Is it?
Do we have to?
At what point is it tradable?
It's like, it's going down.
It's going to be tradable at some point, though.
Yeah. No, it's just got to stabilize. Like, this kind of looks like the pendulum swung too far, and it's kind of out of whack. And I think it'll center itself again and find tradability. But is that in this price range where it stayed for the entire last year? Probably.
I've traded naked puts on natural gas a lot, and the range for years was 250 to 3.
Yeah.
Right.
It seems like it should be a range bound commodity unless there was some sort of natural disaster. That's what happened, right? So.
Well, yes, that's what happened.
Yeah.
But it's such a beautiful cash flow instrument when the volatility subsides, right? And we are starting to see a little bit of that slowing momentum. We're starting to see ATRs come down on natural gas, and it's now starting to get back into the historical ranges where, typically that it does range between that $2.50 and $3 mark.
Yeah, Matt, it reminds me of a story I once read in one of the trading books. I think it was a George Lane quote where, when he first stepped on the trading floor, the old time trader told him the price of corn was 250. And that was it. Like, he made all of his trading decisions based off of whether the price of corn went above that or below that, because that was the mean over the last however many years. If natural gas means 250 or, $3, 350, then you'd look to, buy the lows, sell the highs, because it is a commodity. It's a commodity. It's, it's very much utility based, very seasonal, regulated supplies, things of that nature. So it should stabilize in that price range, I think.
I need to see weeks of data here, though.
Yeah, I'm not going to jump in now and assume.
Yeah, I need weeks of data.
Yeah, I'll wait till it's been defined, like clearly defined.
I want to see 250 hold. I want to see it snap back to 3. I want to see that hold, and then it settled down. I mean, I just don't think, even though the last week it has certainly slowed down, I just don't think it's there yet. We've been fooled on natural gas before.
Yeah, no, it's a lot of momentum down to that price zone, and you think it's going to hold, but until it does, I wouldn't speculate on it.
Yeah, I think you got to be very, very, very cautious with that. I want to take a look at a couple of the stocks that could be setting up here. Noah, get your take on a couple of those. First and foremost, with the Dow Jones just showing tremendous strength, and the Dow is showing a lot of strength on the backbones of the positive news coming out of the Chinese-U.S. trade wars. But let's take a look at Boeing's chart very quickly. An industrial component in the Dow. What you read?
Well, it's obviously moved on momentum. We've seen it. It's retested and it's heading up. So it's a question of whether it breaks those highs. If you break those highs, this is kind of a weird place to trade. Psychologically speaking, you're like, let's go pay the most we've ever paid for the stock ever. Who's in? Let's do that.
Stuff psychologically.
But when it does break a high, technically speaking, you should buy. And so it tends to run if it clears the resistance zone. And there, the upside is big. I'm strong, bullish on the industrials. They knocked it out of the park on earnings, but it'll eventually find a supply zone out there. And I don't know if it's at 420 or 440 or 450. Who knows?
Yeah,
but if it breaks that high, it technically you're supposed to buy, but it makes
it's hard psychologically because as a consumer, as we grow up, we're always like, buy the dip, right? Buy the dip. Buy low, sell high.
That matches our general psychology on trading. It's like we love to buy things on a discount. Mm-hmm. And so, but waiting till the sale ends and paying the most the price, waiting, you'd never do that in real life. Like, you just don't do that with your regular consuming habits.
Yeah.
So it's a total twist on psychology. And it's kind of the old Western version of it, buy low, sell high, versus the Eastern version of it was buy high, sell higher.
Mm-hmm.
So as long as you've got that upward momentum and trend, and a reasonable position size and a stop loss, then go for it. That's kind of what it comes back to.
Yeah, you can't shun a good breakout simply because it's going up.
But you go first, and then I'll go after you.
You'll wait to see. You wait to see.
I'll wait and see.
Okay, I'm more in, but my order would be above 413.88.
Yep.
But I like Boeing here. I want to take another look at a couple other charts here. MasterCard, MA.
Okay.
Okay, MasterCard was on the options report this coming out of the week. It's getting into that 220 area, first target 225. At what point do you personally start adjusting a stop loss on a winning trade?
This one I would already be adjusting on it because it's clearly popped up. It's run a few candles. It's slowing down. There's a big macro benchmark high out there at 225, and it'll probably drift up into that, but then I would see a correction before a breakout. I kind of see this as a macro forming cup and handle. It could blow straight through the 225, but I wouldn't bet on it. I'd bet that it finds some sellers there.
Mm-hmm. Let's take a look at Netflix. We looked at it yesterday in terms of a potential breakout candidate. No, I'm getting excited about this one.
It was so patient. It was so nice of it to wait for us to talk about it again today, not breaking out.
It was so nice. It was so nice.
That's a cup and handle right there. That's a textbook cup and handle, and everybody's playing wait and see. As soon as it clears, I think you'll see a nice buying frenzy and a strong candle.
Yeah, I'm not in yet, but I am looking at this very intently because I love that cup and handle on Netflix here. It's a technical pattern that is called a continuation pattern. The signal on it is so simple. It's just wait for the breakout, wait for it to confirm above those highs, and then Netflix should absolutely run there. I like that one. Let's take a look at WWE.
WWE from the top rope.
From the top rope. Another one on the options report from this past week, Noah. This one, our price target on WWE is 97.5 by 100. It's more of a, we're liking the breakout. We want to see it run into that 97 all-time high. What's your read here?
Well, if you missed the break, wait for the retest. And first of all, shout out to the scouting reports this week. They nailed it. Nailed it. Take credit for the market's momentum, but heck yeah, those are some killer setups and everything's been performing real well. This is a great example.
Almost every one of them triggered. Every one of them are profitable.
Yeah.
I mean, it was a really, really, really good week for bullish VIX.
That shadow right there might have shaken some people who bought early. This is one reason that you wait for confirmation and catch it after it breaks. But yeah, that's a really good breakout. It is slowing down a little bit, and I would expect it to retest. So again, if you missed the pop, wait for the drop.
I like it. No, I want to talk very quickly, just a little bit, do a little bit of a deep dive on moving averages, because we talk so much about them and some people may not understand exactly what a moving average is. So can you take 5-10 minutes and just talk about exactly what moving average is, teach a little bit to our community?
Oh yeah, you bet. There's squiggly lines on your chart that make people want to buy and sell. For whatever reason that is. You're tracking short-term average, intermediate-term averages and long-term averages. There's different kinds of moving averages. You've got your simple moving averages, which give equal weight to the data that they track, versus an exponential moving average, which focuses it retabulates the most recent data, so it gives it more sensitivity to the price movement. And there's common moving averages that people use that become really strong reference points. And I've oscillated back and forth in my own trading, whether, when I'm using them, when I'm not using them. And I usually keep them on my charts just for talking points for new traders, because I usually have a pretty good idea of where they're at. And I make most of my personal decisions off of support and resistance, actual known price pivots. But you have to pay attention to those moving averages, because enough traders do that I think you'd be missing opportunities to catch a buy off of a 200 period moving average, or that type of thing. When the stock gets where like WWE, it's up above all the moving averages, there's no doubt that you're running pretty bullish. When stocks start dipping below moving averages, that's a sign of weakness. And there's certain benchmarks, if the stock breaks below the 200, there's lots of traders out there who say never buy a stock trading below its 200. Or never, don't buy stocks if they're trading below their 50. They have simple rules like that keep them trading with overall trends, and they're really good mechanisms. I kind of consider them like training wheels. They give you an idea of where you're at. There's a strong probability for revision to the mean, so they usually don't get too far away from that mean price, the average price, and they're just good reference points for traders to just help them to identify opportunities to buy, and when you get and or to sell sometimes. They act as support and resistance because they can be catalysts for people to buy and sell. And the 20, the 50, and the 200 are the most common simple moving averages. And then short-term moving averages, people use all kinds of moving averages. I use an 8, Mark uses a 9, somebody else uses a 10. And I think they're really good, simple lines in the sand. Hey, if it crosses below the moving average, sell.
You're absolutely right on those EMAs, and that's what you're kind of talking about, the 8, the 9, the 10, the 11, the 13, right?
Yeah.
We've seen so many different systems and philosophies on those EMAs. SMAs don't have that though. With the simple moving averages, almost everybody uses a 20, a 50, and a 200.
Yeah, and those go back to those go back to what I was talking about earlier, Matt. It's a month, a quarter, and a year. They're just rounded off because back in the day, early technicians didn't even have pocket calculators. That wasn't invented until like the 70s. And so early technicians did monthly, quarterly, and annual averages, just rounded off. And
they would dot plot it is basically
what they were plotting it by hand. Like one of the first people I worked for in this industry was a guy named Stephen Akalis. He wrote that book, Technical Analysis A to Z. And you got that book right there, I'm sure. It's a great story. His dad was a trader and investor, and he was taking the newspaper and plotting it out by hand, graphing it out. And his son was like, "Dad, that new Commodore 64 you bought me for Christmas, I bet we could make the computer do the graphs." And that's how it started for them. And
that's awesome.
That's where Metastock came from.
It really, I mean, it's a technical book. It's a great book, very helpful. It's one of the first technical books I read.
Yep. And he took his skills and parlayed his software skills into like running ski patrols and things of that nature. But he founded the Metastock. They became the number one software for a long time. Sold the data to the institutions. It was a pretty cool story. But to go back and think about his dad plotting it by hand when the newspapers were giving quotes in fractions and not decimal points. Yeah. And trying to plot out an average. Those are the things that when the advent of the PC, traders were already accustomed to using those, and so that's what they put in. And now they're kind of an industry standard. If
it's almost the same way as the settings on ATRs and MACD and stochastics. Despite the market ever-changing evolution of the market, that we still use the exact same settings that people were using in the mid 80s. Once it becomes in the social conscious of traders, they just use it over and over and over again. But the EMA is a little different. You have lots of traders use a lot of different settings. Like you said, you like the 8. Mark prays to the altar of the 9.
For sure.
Prays to the altar of the 9. If it's not above the 9, it is not a legit setup.
Oh yeah. Well, I sent the 8-period exponential moving average missionaries over to see if they could convert him to.
No. He's slammed the door.
It's not going. He slammed the door in their faces. He's like, "Nope, I've already got my God." So yeah, no, and those are interesting ones because people sit and tweak. I used to sit and back test moving average crossover systems, Matt, and I would have the computer run the optimization. It would test like every moving average combination. It would find the one that matched that particular stock's personality the best and gave strong buy and sell signals. And usually it ended up being a short period moving average, something like a 7, 8, 9, 10, somewhere in that ballpark. And then a longer term moving average, somewhere around 18 to 21 some odd periods. It was really, really common. And so what I started to figure out is, yeah.
So let me get this right. So basically you were back testing that 7, 8, 9, 10 EMA crossing over in 18, 19, 20. Just
moving average crossover. It would change the settings, run the data, and count how many points the computer would catch off the crossover.
Gotcha.
And so you'd take 5 years worth of data and have it crunch the numbers. Now, this is back in the day. I was literally downloading the data on a dial-up modem. It would take an hour just to download the data, and then it would take the computer another hour or two to run the simulations. And it would spit out the answers for you. And what I noticed is that they would switch around a little bit from stock to stock, but they always wound up in that same ballpark. And it kind of dawned on me. I'm like, oh, well, you got these weekly cycles that last about 8 to 10 days. And then you have longer term cycles that are lasting, 21 some odd days. And so when you get crossover systems, that they only really cross when you get a true reversal of trend, or a short-term reversal of trend, excuse me. It tends to be a pretty decent looking signal in hindsight. Like you can see it right here, like, hey, buy when they cross up, sell when they cross down, you catch a few points. Sell when you cross down, buy when it crosses up, you catch a few points. Same type of thing. You buy when it crosses up. Well, they cross down, they cross back up. So you'd be buying it and you're still in it right now because it hasn't crossed back down. So you're catching some points there. And figuring out which short-term moving average to use, I think honestly comes down to preference. If you're in that ballpark, 8, 9, 10 ballpark on the exponential moving average, you're in the right ballpark.
Mark prays to the 9, but there's not a whole lot of difference between the 8 and the 9.
Yeah, I know. Seriously, I'm so surprised that he couldn't be.
We're talking fractions of cents.
We're talking about 1 day's worth of data.
but you know what? It works for them, and you know what? It works for a lot of other people. EMAs are a very helpful tool to be able to use, whether you use an 8 or 9 or a 10. I mean, like you said, it's personal preference. But on those SMAs, it's 20, 50, and 200.
Yeah, everybody's using the same ones, and the fact that you hear, like I said, like you hear the commentators on CNBC, which I don't watch anymore. I have to turn that crap off. But tune into the halftime report. You get real information, not just stuff trying to sell Viagra in the commercial breaks. I just said that. Yes, I did. But
I was taking a moment on that one there, Noah.
But think about it. You go watch CNBC and it's either financial services or pharmaceuticals. That's what they're selling.
It's true.
So you've got those classic moving averages that become, I think, self fulfilling.
Wait a second. So are you suggesting that media would hypothetically pump up stocks that they're doing marketing deals with?
Maybe, who knows? I don't know about that, but I know that Jim Cramer's foundation owns that stock when they say that. But other than that, there's we're easily manipulated.
We are. But again, it doesn't matter on the 9 versus the 8. Choose a setting, but keep it on a chart. It's a great way to, handle crossovers with the EMAs. It's a great way to use the SMAs as support catalysts, and especially if you're new to the market and you're struggling with identifying how to identify support or resistance levels. Those moving averages are support and resistance, and they have been support and resistance for decades and decades now. Whether we were plotting them with dot plots back in the day with, Achilles' grandfather or father, or, it's doing right here on the chart. EMAs are a wonderful, wonderful way to track momentum, crossovers, SMAs. I like SMAs more as a support resistance type catalyst and trend following tool.
Yeah, for sure. And like anytime you run scans and filters, like if you're running your FinViz scans and things, simple filters to put in, find me stocks rising above the 20, find me stocks above the 50, find me stocks above the 200. And that filters out anything that's not already in an uptrend, and vice versa. Like you can set those moving average filters, find me stuff that's 10% away from its moving average. You can find stuff right in the zone where you want to buy. Play around with those filters and it'll help you find candidates.
I love it. Well, Halftime Crew, thank you so much for joining us for today's Halftime Report presented by Tackle Trading. If you haven't done so already, please give us a like and share. And thank you so much for being the best part of Tackle Trading, ladies and gentlemen. And for those of you who have not done the 7-step guide to trading, we have our we're just learning on the fly here, Noah. We have our 7-step guide on Udemy. You can go check that out on Udemy for free if you are new to Tackle Trading. And if you haven't done so far, you can also find the 7-step guide to trading over there on Tackle Trading's website under courses as well. For the pro members of Tackle Trading, we got a couple events here tonight. We are holding our Tackle 25 Mastermind group tonight. We're going to do the update in March as we get more data. And we also have the Canadian Mastermind group tonight in Mind of the Trader series. So we have a couple different events here tonight with the Tackle 25 cover calls, the Canadian Mind of a Trader webinar with Greg Holmes. So make sure that you're supporting that and showing up for that if you're part of the Tackle 25, or if you want to be in that Mind of a Trader webinar series as well. And until then, guys, we'll see you tomorrow in the Halftime Report.